This podcast is sponsored by DeLamarter. DeLamarter was founded by a former hedge fund analyst. He didn't have a tool that he trusted to be 99.9% accurate that allowed him to pull the updates directly into his existing models and that had the granularity and KPIs, guidance, and non-GAAP adjustments that he needed. So he built DeLamarter. DeLamarter is the fastest growing source for public company data, with data available for over 3,000 companies. Hundreds of AI algorithms collect and organize customized company historicals with an accuracy level and depth of data that is higher than anything achievable by other modeling tools. Each data point is audible to the source. DeLamarter's Excel plugin is the first to allow you to update your models in your existing format. It's simple and non-invasive. DeLamarter's clients are able to cover more opportunities and generate more ideas. No more data errors, no more Excel monkeying, just the fundamentals. See why equity investors are switching to DeLamarter. Visit DeLamarter.com/YAVP. That's DeLamarter, DALOOPA.com/YAVP to learn more. All right, hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could follow, rate, subscribe, review it wherever you're watching or listening. With me today, I'm happy to have the team from Half Moon Capital, Eric, DeLamarter, and Brandon Carnovale. Guys, how's it going?
Good morning. Thanks for having us.
Yeah, appreciate it. First time, long time, Andrew.
I appreciate that, and I'm really excited to have you guys today. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. Please do your own work, consult a financial advisor. This isn't financial advice. And then second, the way I start every podcast with a pitch for you two, my guests. I mean, you two do great fundamental research. I've been doing it for a while. Eric, when I was researching this podcast, I remember I looked at Tile Shop a couple years ago, and there was a bunch of stuff from you specifically on Tile Shop. But y'all do great work. I'm really excited to have you on. And we're going to talk about, I believe, your kind of highest conviction name today. So I think that's really going to shine through. The company we're talking about is Oxford Industries. The ticker is OXM. And I think Eric was going to start off. So I'll just kind of pause there and toss it over to Eric. Brandon can jump whenever he wants. What is Oxford Industries and why is it so interesting?
Yeah, Oxford Industries, OXM, as you know, is a company we've been involved with since earlier in the summer. It's a business that I think there's a handful of misconceptions, confusion. The core business itself is Tommy Bahama, which is about 2/3 of revenue and the biggest driver of the fundamentals, to a lesser degree, LULU, Pulitzer, and some smaller brands. We have done an extensive amount of diligence on this one, to kind of glean these insights that we have that I think over the next couple of quarters will illuminate the value, kind of disprove some of the confusion and alleviate some of that misperception. And that's kind of the setup from a high level. Happy to get into those details.
Brandon, you want to add anything?
Yeah, I'd say, I think how people maybe know it best is if, like, you go to the beach. Eric and I went to the beach over the summer. You're going to see a sea of Tommy Bahama. It's not going to be their polos as much, at least in the Northeast, but you're going to see the umbrellas. You're going to see the lawn chairs. And I think that's, probably how people know it best. Or if you're just here in Manhattan, you're walking down Fifth Avenue, they have a great location. They got a Marlin bar. I think we were talking earlier. We're going to have to go check it out pretty soon, grab a coffee. But yeah, I think that's, like Eric said, 2/3 of the business. And then there's Lily Pulitzer, which is also like a fun female fashion brand, also on the beachwear. And then they have a couple of smaller, higher growth brands like Southern Tide and a Duck Head. And then I think Johnny Was is a little bit of a newer acquisition. That's not really their strategy here, but it is very, I think, on brand and exciting, double-digit grower, high-margin business.
We can talk about lots of stuff, but just one thing that pops into my mind with Johnny Was, and we can probably address that later, but, CROX, which is kind of a loose comp here. Obviously, people are going to be looking at evaluation, but they did the HeyDude acquisition over the summer, which at the time I looked at it and was like, oh, this is a weird brand. And it's early, right? It's only been a couple months, but so far, I think as people have kind of started seeing those numbers and seeing the growth of the HeyDude, I think that's proved to be a very astute acquisition. Now, Johnny Was is a little bit smaller for OXM versus the whole company compared to CROX HEYDUDE. Anyway, I guess I'm jumping on myself. Let's talk, so OXM, they are a little handful of a couple of different brands. The two big ones here are Lily Pulitzer and really Tommy Bahama. So I just want to spend a second and talk about, Brandon started doing it a little bit, but talk about Tommy Bahama, because I think people might see the brand and think, oh, it's this lifestyle beach brand. There are other lifestyle beach brands. I kind of want to dive into why you guys think this is more than just a fad brand or a knockoff brand, like why there's real brand strength here.
Yeah, I mean, that was kind of our perception when we first looked at it. I think a lot of folks in big cities on the coast think loud Hawaiian tropical shirts. In fact, that's only about, as we discovered, about 3-4% of the business. These are actually high performance clothes, tees, polo shirts, pants, to a lesser degree some women's fashion in the Tommy Bahama category. And this is stuff that is very popular in the South. Demographics skews towards retired folks, 60 plus. And these are clothes that these folks, that's the only brand that they buy. In the Marlin is something that they pay a premium for. It's essentially a luxury brand. If you look at the margins and the price point and, frankly, the lack of discounting and channel in which they operate.
So Eric, just one thing you said, 60 plus. So you think this skews a lot older in terms of the main demographic consumer?
Yeah, we've found that is the case. The kind of typical guy that buys these clothes are a bit older, retired, and it's almost 98% domestic American. So,
okay, Brandon, do you want to add anything there?
Sure. Yeah. So I think on the question on Tommy Bahama. By the way, I'm doing a little product placement here. If any, I don't know, Tommy Bahama's watching, feel free to send me a little paid promotion. But yeah, no, I think Tommy Bahama is a fun brand. I think Eric really touched on is, if you walk down Manhattan, there's a lot of guys in polos, but they're not Tommy Bahama. They may, have the beach chair when they go to the beach in Westchester, but when you go to Florida, like I was there for Father's Day, which is their key selling day. I mean, this is dads, like Eric said, it's dads over 60. The Tommy Bahama in Fort Myers was just, packed. There's not a seat in the house. The retail store, magnificent. And then a lot of people, it's interesting that Tommy Bahama really does view themselves as a luxury brand. And I think but investors maybe not yet are viewing this so much as a luxury brand. And I think one of the perks of that is, this year they raised prices by, X, we don't tell us, but they raised prices by X%. And then just keep reaffirming, we've, never had any pushback on that. This is people, like he said, 65-year-old retiree. A lot of them are actually going on vacation. So I was, running on the West Side Highway and you see people here taking pictures, and I've seen a couple of guys wearing Tommy Bahama. This is like their vacation where on Cyber Monday, I think cruise bookings are up 50%. They have a store in Fort Lauderdale. Everyone in that line, a lot of people in that line are wearing Tommy Bahama to go on their cruise. It's like there's some really interesting drivers here that have obviously allowed them to grow at 20% when, I think initially consensus was looking for low single digits. So there's been just some really interesting drivers that we think are longer term emerge here.
Yep. Yeah, no, look, my first experience with the brand, I didn't even know it at the time, but during the height of COVID, my wife and I evacuated to Fort Myers. And I remember we went to Naples and we were walking around and we were like, Tommy Bahama, like they basically controlled an entire block there. And we were shocked. And there were, it was packed. It was December, COVID in Florida, so COVID kind of wasn't existing anymore, but the thing was packed, and I had no idea that they had that brand strength, and I think I told that to you guys when we started doing this. Look, I'll give full disclosure, I feel like a bad podcast host. This is not a Tommy Bahama floral shirt for the people on the thing, though. Tommy Bahama is very much in my brand. My wife and I, we've got plans to go. We've got reservations for next week to go check out the restaurant, so I will be checking out the Marlin Bar. But I guess from a bull case thesis, the thing that strikes me as a bull case, I was looking at their Q2 call and they started saying, hey, one thing we're pushing into is pants. And Eric addressed one of my things. I was like, oh, this is all floral shirts. And they were talking about, hey, we're pushing into pants. We're pushing into other things. We're adding features. And so is the bull case here like Tommy Bahama is kind of following the Lululemon path, right? Where Lululemon for years, people would say, oh, it's just yoga pants. It's just yoga. And now that's a lifestyle brand. It's a solid brand. I mean, it trades for like 20, 25, it trades with a Nike like earnings level. Is that kind of the bull case path that you guys see for Tommy Bahama?
100%. Yeah, no. And I think just along the lines of Lululemon is, we don't think we're going to get 20 times earnings per share, or anything even higher than that. So we don't want to have our investment thesis contingent on us earning a premium to Lululemon. But, if you look at Tommy Bahama's financials, Oxford's financials, they are growing, almost as fast. At least, this year probably even faster. All organic, all same store sales. They're not opening up new locations. It's e-commerce driven. Retail revenue from 2019 today is actually flat. It's just been purely e-commerce, and that's what's improved the margins by so much. And they have what Lululemon doesn't have is, well, maybe they do, but not to this degree, is the royalty income. It's 100% margin for them. So like one of the things they just did, they launched a suitcase with Samsonite, which is like a luxury, $400 suitcase. They're going to earn 5% of sales on that. I mean, it's below 5%, but it's in that ballpark. And that just hits their, it doesn't hit revenue, but it just hits their bottom line. And that's why, their EBIT margin, which kind of screens pretty high, is because I think that's one of the big drivers here. And that's been growing, 20% year over year. And that you can see umbrellas and the lawn chairs you see at the beach as well.
Yeah,
Eric, did you want to add anything there?
Yeah, we were discussing this actually the other day. In fact, looking back to Lululemon, it reached this point about 4 or 5 years ago, whereby skepticism started to arise that this is, the product is going to get knocked off. They weren't going to be able to move into parallel apparel type categories, and there's, it was there's a kind of a decent short interest, and then since have clearly proven that is not the case and maintain premium pricing. Alternatives have existed, but people want the Lululemon brand. Here we sit with Tommy Bahama. Very similarly, people are like thinking, why don't you just go buy your shirts on Amazon? Well, people want the Marlin logo, and that's kind of playing out now. You're seeing the pricing, the margins, the sustainability of that. And I think the next couple of quarters, it will really kind of come to bear and illustrate that, disproving that short thesis or the skepticism that kind of overlays the valuation.
And we're going to talk valuation and skepticism in a second, but I just want to come back to one thing Brandon said there. Like, Brandon, the 5%, Samsonite's a real brand. They're clearly licensing this because they think they can sell suitcases in this case at a premium by putting the Tommy Bahama and the Marlin brand on there. My guess would be, hey, when you've got something licensed, it speaks, it helps build up the ecosystem, the kind of like brand ecosystem a little bit because people get another connection point there. But B, it just speaks to, hey, slap a logo on and you can sell the same suitcase for, it's probably a 20% premium that's the only reason they do it, right? You can sell it for a huge premium. There's going to be demand there. It speaks to a brand with real strength. I'm kind of lobbing you a softball, but I just wanted to dive into that for a second.
I think you touch on a lot of really interesting points there. So the Tommy Bahama, because it is vacation, now you have suitcases. So there's like a natural shift there. It is, I'd say probably more is older people, so they could really have that disposable income, so they can pay for a Samsonite bag. And yeah, I think Tommy Bahama, they just really have figured out this licensing. Like back in the day, they used to have an RV, like a Windstream. Like you want a vacation in your Windstream, if maybe that's retirees, there's like a natural connection there. I'm sure you saw too recently, they did a resort out in, I think, Nevada, if I remember correctly. So they're going to be a Tommy Bahama hotel now that you can go and stay at. And they rebranded that, an existing hotel, to Tommy Bahama, because, they think it's just, people like this, it's a fun brand. It's a little whimsical, but people, when you say Tommy Bahama, I think everyone has something in their head that they can kind of relate to. And it's got those kind of beachy vacation vibes that everyone likes to associate with.
It reminds me of Jimmy Buffett has Margaritaville, and people probably laugh when they hear it. I laugh because it was in the FTX bankruptcy that I think FTX owns a Margaritaville restaurant like $55,000, which I don't know how you get to a $55,000 bar tab. That's pretty aggressive. But Margaritaville is a literal multi-billion dollar business, which slaps brands. People want to live the Margaritaville lifestyle. I know in Florida they're building like a Margaritaville themed retirement community. Basically, they've got the restaurants, the hotels. Like, that is a massive brand, lots of licensing, and I could see Tommy Bahama kind of it's leaning in that direction, and that probably, I'll let either of you guys speak to it, but that'll probably lead us nicely into valuation. When you say, hey, Margaritaville, this $3 billion brand, you can probably start talking OXM's overall valuation and everything.
Yeah, no, I think that's right. There's parallels, not necessarily as like party lifestyle, but this kind of like leisure and comfort and kind of beach element to it that a lot of people have adhered to. There've been shift in population in the southern states and acceleration in retirement. So those are all kind of tailwinds that are benefiting them. And they've, over the last 30 years, year after year, taken on these new customers, people that are retired and or on vacation, and it's kind of proven sustainable. And I think they've done a bunch of things over the last 2 years. Really, they've changed kind of the structure of the business, the margin profile, and what I think is going to be translating to these higher kind of continuous earnings.
Cool.
So I need to touch on one thing. Well, one quick thing there in the licensing, just so people understand like the magnitude of it. So Tommy Bahama will do $850 million of revenue this year. I mean, sorry, that was like their initial guidance over the summer, $850 million. But overall, the brand will do maybe $1.3 billion in terms of revenue. So there's like $400 million of licensing revenue, and $25 million of that $400 million will hit their balance sheet as just pure income. And that's not something that that's actually like a little quick data point we found in this WWD 30-year anniversary for Tommy Bahama. They got a little profile, and the CEO had mentioned that statistic. But just like a little just to maybe quantify what we're talking about for the license revenue.
I guess rough numbers. If people look at the LTM, I mean, the LTM for Tommy Bahama is $830 million in revenue. And what you're saying is, hey, that's a lot, but it's actually bigger than that. This brand is kind of punching 50% above its weight if you were just looking at the financials.
Exactly.
Let's turn to valuation, because I think valuation will bleed nicely into talking about, I think there's a pretty active short thesis, or maybe some sell sides don't get the valuation. So I think talking valuation will bleed nicely into that. So either one of you can start. As you and I are talking, this is about $110 per share stock price. What's that translate into market cap, enterprise value, valuation, all that?
So I got the financials in front of me, so Eric, feel free to jump in if I missed it. But I think what really pops off the page, earnings per share is up 142% since 2019. And I think, what really caught our interest initially is that this management team is focused on GAAP EPS. Like they guide to GAAP EPS, they buy back stock, they do accretive acquisitions. So you're getting GAAP EPS in this business, and there's 100% free cash flow conversion. So I think that's kind of maybe the metric that we're focusing on for valuation here is, but like I said, the EPS is up 142% since 2019, but the stock is not. And we think the delta there is people saying, okay, this is peak. So I'm sure we'll touch on that a little bit later about why we don't think it's peak, but just right there, you kind of keep the valuation multiple flat. The business has just improved by so much since 2019. Margins have doubled. The business historically was in the wholesale channel. They've totally flipped the wholesale channel now into direct to consumer. It's 80% direct to consumer. So if you kind of look at where a Ralph Lauren is, they're a majority wholesale. So it's not as attractive. You're selling in a department store, secular decliners, closing locations. These guys control that distribution channel. And where they've we call it soft guidance in the 10K, they said, we expect our growth to come from the e-commerce channel. And the e-commerce channel is just so much higher margin for them. But yeah, so on valuation, you look at Columbia Sportswear. We look at Deckers Outdoors. These are some of like the higher growth tier guys that are doing double digit growth with expanding margins like Tommy Bahama, and they get mid-teens PE multiples. When we look at consensus next year, we think it's very conservative. We think if this business just continues to grow at 0%, the terminal value implied in the business is negative. So it's like that right there is a huge upside scenario. But yeah, so how we get to that $188 price target is just looking at, like I said, I think a Columbia or a Deckers or not Lululemon, but these guys are higher margin, better returns on invested capital, and going to be around for the next 30 years like they have the prior 30 years.
Eric, did you want to add anything to that?
Yeah, no, it's on that. So we're trading like 10 times at the current valuations. To clarify where we stand, the discrepancy between that and what we think it should trade for, and happy to get into like some of the reasons why probably that discount exists.
Yeah, no. So I guess the first high level is, I looked at, they've got all their peers listed in their proxy. There's Buckle, Carter's, Chico's is in there, Children's Place. And then the three that Eric mentioned, Deckers, Columbia Sportswear, and Lulu are all in there too. And what you guys are saying is, look, the median, I've got my little Bloomberg pull on my right. The median of those peers trades for about 10, which is about where Oxford's trades for. But the best, which would be Deckers, Columbia, and Lulu, all of those trade for, the smallest is Columbia at 17. And then the others are, Deckers is 20 and Lulu is way over 20. You're saying the simple thesis here is Oxford has Tommy Bahama. Tommy Bahama is one of the best brands in here. It should trade for a multiple that's kind of in the top quartile of brands here. So from 10 to 17, that's your very simple thesis right there.
It's a part of it. And I think, so multiple expansion is huge. So I think one interesting thing about these guys is they're 96% North America. That's the highest of that comp group. So you're not taking Europe or Asia or China risk right now. Like I said, direct to consumer. So I think when you look at the valuation discrepancies, a lot of it is, are you selling into department stores where you don't control the pricing, or are you controlling the customer? I think the other big variable there is, going into this year and maybe even the last couple of months, the expectation was that earnings per share was going to decline, revenue was decline. So we think that buy-side expectations, investor expectations were just so far below consensus. They were really overly discounting those consensus estimates to kind of hedge that this business was just going to turn over next year. So they really weren't pricing in consensus yet. And I think what we've seen is, as these guys have continued to deliver, I think our big catalyst was, Citi is going to flip from a sell to a buy. They flipped from sell to neutral, and the stock went down 3%. So that was like, okay, we got the fundamental improvements, but we didn't really get the valuation we were looking for. But we've started to see the narrative, I think, really shift towards, okay, maybe this is going to be a long-term grower, spectacular business that should earn the valuation of a lot of the businesses you just mentioned.
So you mentioned the Citi report, and I think, generally, I'm sure all of us don't like to get hung up too much on quarters, but we're talking December 1st, 2022. We were talking before, we're right in the midst of all of the kind of soft lines and retailers reporting. And one of the reasons we want to record this today is so we could get it out before Oxford reports their Q3 earnings next week. So I just do want to talk and this bleeds nicely into another of the bear thesis. Brandon started to mention it. Earnings are way up since 2019. 2019, they do about $4.30 per share in earnings. This year, they're guiding for over $10. And I think people look at that and say, this is a business that way over earned during COVID. You think about Tommy Bahama, being outdoor, living the beach lifestyle, 2020, 2021, that's what people were doing, right? They were getting out of my one-bedroom apartment in New York City and they were going to the beach. So I think people look at that and say, everything retail over-earned during COVID. And these guys especially might have over-earned because people were just really going to where their stores are focused, where their lifestyle is focused. And they're looking at that and saying, hey, 2023 might not be great because you've got this over-earning pullback. You've got all the promotional environment and everything we're talking about. And then I even think for, the quarters coming up, people are looking at it and say, the environment's getting really rocky out there. We're seeing a lot of businesses that are having to promote like crazy. People are stuffed with inventory. So I think there's like this quarter risk out there. And there's kind of the 2023 lapping the 2019 COVID boom, all that type of stuff. So I threw a lot out there. I'll let either of you talk if you want to.
I think you really touched on it. No, that's great. And, when we talk to people, that's what they tell us. Q3 is a little bit de-risked, not de-risked, but they did the Johnny Was acquisitions, and then they pre-announced, okay, we're actually raising organic growth guidance because demand for Tommy Bahama and Lilly Pulitzer is just coming in stronger than expected. And Q3 is their seasonal low quarter. So when Q2 was really strong, we're like, okay, everyone just went on vacation, are they keep going? And then Q3 is coming in a little stronger. And now we look where Q4 estimates are. And, maybe we'll dive into this a little bit later where we kind of differentiate from consensus estimates. But if we just assume Q4 is say like a seasonally in line quarter like it has in 2019 and years prior, there's a decent amount of upside to those Q4 estimates. We don't really think they're reflecting how strong of a push Tommy Bahama makes. Usually Q2 and Q4, they're two big quarters. And they are usually about equivalent in revenue. So we're kind of making that assumption that's going to stay fair and correct this year. And then it's like, yeah, there's at least 10% upside to Q4 revenue there, and then just keep going from there.
Brandon, you mentioned on the Johnny Was acquisition, which happened a few weeks after they announced Q2. They came out and they said, hey, we're raising our full year guidance. And part of that is because we're doing an acquisition, but another part is organic strength in our two key brands. I think they raised EPS targets a little bit and everything as well. Do you think because that was like paragraph 3 or 4 of an acquisition press release, it kind of buried the lead? And I mean, obviously sell sides are going to pick up on it, but do you think it didn't kind of get the notice that it would have if they had gone to a conference and put out a press release that said, headline, Oxford Industry raises guidance on strong organic trends or something.
Well, I think the funny thing is people here look at Oxford Apparel and say, I don't want to own a contract manufacturer so it's like that company raising guidance doesn't remove the stock either. And the other thing Eric and I've been laughing about is too, is, we see some retailers report earnings and maybe they only decline 2% versus 5% as expected, and the stocks go up 20%. Burlington, great example. Stock goes up 20% because they only declined, I think, 17% this quarter. And that was better than the 20% expected. And the stock just ripped.
And if I remember correctly, they came on the call and they said, look, our systems are way worse than all our competitors, but we promise we're going to figure it out over time. It just takes time. And I'm laughing because I kind of flipped through that call and I remember reading it and being like, the stock was up on this?
Yeah. So to your point, Tommy Bahama says, yeah, we're actually going to grow 20% instead of 15% or, whatever exactly it kind of bakes into, and the stock barely moved. So I think there's definitely something there.
Eric, did you want to add anything there?
Yeah, I mean, this is the name whenever we discuss it with others, they've never heard of it or they're familiar with Tommy Bahama. And again, how does that get rectified? Change the name of the company, Tommy Bahama Company or something like that. They're going to be doing an investor day next year. They improve some of that outreach. It's a great story. They're articulate management team, very solid operators. So I think we'll start to see some more of that now that a number of these shifts in the business have manifested themselves and we're kind of coming out of and probably entering a more normalized environment. I think that setting and setup and timing for that will be attractive for them.
Yeah, no, I'm just laughing because I think you're exactly right. I mean, I knew we were doing a podcast on this. I read the Q2 call last night. I was getting ready. I tweeted out, hey, we're doing a podcast on Oxford. Does anyone have any questions? And then I tweeted out and I looked and I was like, oh, that's Oxford Industries. That can't be the right company. I just tweeted out the wrong thing. And I was like, Andrew, You've been looking at this. Like, I do think there's something. Let me just dive a little bit more into the bear case here, right? So, and I do want to switch this into a little bit talking management. You guys mentioned they're going to get more articulate through the investor day, but I went back. So the CEO, he's a lifer at Oxford Industries. He becomes CEO in 2013. I think he was CFO before that. He's been VP. He's been here since the 90s. He takes over in 2013. That year, Tommy Bahama does $627 million in revenue and $71 million in EBIT. By 2019, Tommy Bahama is doing $677 million in revenue and $56 million in EBIT. So, revenue up 10%, EBIT down 20%-ish, right? So I look at that, and then in the last 12 months, Tommy Bahama's $831 million in revenue and $160 million in EBIT. And I just, it is hard to look at those numbers and say, hey, for 5 years, the Tommy Bahama brand was kind of flat-ish, and then you get COVID and this brand spikes. And it's hard for me to look at that and say, what accelerated this in the past 3-ish years aside from COVID? And, COVID could be people came to the Tommy Bahama brand, they liked it, and you built up a real brand there. Like, people have created real brands. But I just look at those 5 years in 2014 to 2019, I say, ooh, that wasn't really a great time for Oxford. And I wonder if that kind of disproves some of this thesis.
Yeah, I mean, those are very valid points. And yeah, I think we totally agree. And if you want to make sure this business isn't over earnings. And I think the metric we kind of look at is, it's been around 30 years. In 1999, I think when it first earliest financials, they did 300 million of revenue. It's kind of grown at like low single digits since then, including this year. So I think that's how we put back into it, because there is some noise in the 2-3 years prior where they're really dogging sales growth by doing this rotation from the wholesale channel to the direct to consumer channel. So when you're taking revenue from one channel and trying to push it into another one, your lower price here, it's higher price here. You got to get the customer to follow you. So that definitely created a little bit of an overhang. And back then, the funny thing is, the stock still trade for 15 times earnings per share. But in terms of, what's really changed, I think there's somewhat of a, we don't want to overstate it, but there's somewhat of a pop culture phenomenon to Tommy Bahama right now. And I think where we see it is that, we're usually watching a show on Netflix or something on Hulu. Everyone knows Craig Robinson from The Office. He just got a new show called Killing It, where he kills snakes in the Florida Everglades. There's a scene where the guy's wearing a Tommy Bahama polo. and they zoom in on it. So it's like pretty authentic there. There's another movie called Barb and Star go to Verta Del Mar, which is like a Florida resort with Kristen Wiig and some other big names. And there's a character called Tommy Bahama, like in the movie. And there's another scene where, you know, Kristen Wiig meets a lady and she goes, "You got to go to this resort in Florida. The men, head to toe, Tommy Bahama." And it's like the movie based in Florida, and they're really repping Tommy Bahama. And, you know, there's a, you know, everyone knows Melissa McCarthy, but she has a new show called God's Favorite Idiot. I think she kind of like pairs into someone for wearing a Tommy Bahama polo. But there's just all these movies we've seen in the last few years come out, and they're like talking about Tommy, and this is a small brand, and everyone's kind of like talking about it in reference to Florida going to the beach. So we think it has kind of captured the imaginations of a lot of people.
That makes sense. Eric, did you want to add anything there?
Yeah, I think one of the kind of structural changes that COVID beneficiary for them was these are older folks historically were shopping maybe in stores. Now a lot of them start shopping online. It's easier to kind of access those people. They've increased the, you know, wallet share of those individuals. And our diligence is with that essentially a small percentage of the shoppers or customers account for the bulk of the sales. So these are people that everything they buy is Tommy Bahama, and that's kind of spread. And it's, you know, they've done a number of marketing initiatives to improve that. It's kind of a nascent kind of marketing initiative program that they've kind of relaunched effectively through the website and through some other programs just over the last 2 years. So that's really, I think, a permanent change that I think will continue to benefit them.
Do you Tommy Bahama, just something that jumps out at me, just because they've got maybe a little bit of a older demographic shopping them, do you think one thing people might be missing is, like, I look at their Instagram and there's about 85,000 followers, which is not small by any means, but, you know, it's probably a little bit behind some of the comps that we've been talking about. Do you think just because, I mean, look, 65-year-olds, 60-year-olds probably aren't on Instagram, people might look at that and like underestimate the brand strength? And I use Instagram, but we can probably talk other social medias. I just use that as a very high level example.
It's so funny you said that, because, you know, we had the opportunity to speak with one of their former marketing guys, just super knowledgeable on it. And he goes, yeah, you know, they've historically just done mail inserts. They've just, you know, pushing that channel. They haven't really navigated towards e-commerce in the last year. And I think one thing we learned is that last year they did a massive overhaul of the website. It used to just be people dancing around on the beach in floral shirts, and they've kind of started to regroup it. So I think that's all, you know, super interesting there. And then, like, and how we were kind of looking at it too, and how, you know, beginning of the year consensus was positioned was 2021 was the catch-up year. So they did 720 million of Tommy Bahama revenue last year. That was above the 676 million they did in 2019. So everyone said, okay, that's a full catch-up by, you know, a huge amount. Revenue was up 72% last year. And then in the first half of this year, you know, they're lapping super easy comps where revenue grew over 100%. And it's like, oh, are they really going to be able to put growth on top of 150% comp? It's like, sure enough, they grew 17% last quarter, and their toughest comparison of the year.
No, that's great. Let's go back to management real quick. So again, I mentioned the CEO is a lifer. He owns about $15 million worth of stock, which I'd love to own $15 million worth of stock. It's not nothing, but, you know, he makes about $4 to $5 million per year. He's a lifer. I just want to talk both management strength, and I guess the thing I was going to was I was surprised it wasn't a little higher kind of insider ownership there. I think the person who was at the wholesale business that they kind of disposed of is on the board still and has a little bit of ownership, but I was just surprised there wasn't a little bit higher insider ownership. So I want to talk that and management strength there.
Sure. I think we really, 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 really like management.
Do you love him or do you like him? There are a lot of realies in there. I feel like you're about to drop the L-bomb on him here.
I could even throw in a couple more realies, but yeah. So we think they're doing the right thing. They think about the business the right way. You know, they're allocating capital to shareholders. They're focusing on GAAP EPS. They have, I think, the right incentives where they are aligned with shareholders, and you know, I think they'll continue to deliver. I'd say they manage the business very conservatively. So they're not like out there promoting the business, which at times we're like, just tell them you have such a great story, just get it out there.
Yeah.
And they don't really do that too much. So I think, management, A+, we want them to just keep doing what they're doing. And
Eric,
then,
go ahead.
what was the other question?
Insider ownership and management, which I think you were addressing, but Eric, did you want to add anything there?
Yeah, I mean, I think they've been very disciplined capital allocators. I think that's something it's critical to us, right? So generating a lot of cash flow, had previously been buying back stock. We just did Johnny Was acquisition. That will go to debt pay down and then share repurchases. And so we know where the capital is going, and they haven't made blunderous acquisitions in the past. These have all been logical fits. They can deploy their strategy to these new brands they're acquiring, grow them with that playbook. And I think we'll start to see that with Johnny Was as they have with the prior brands they've acquired.
Yeah, so I guess let's just quickly talk Johnny Was. So this was an acquisition that was announced mid-September, $270 million acquisition. Oxford is a just under $2 billion market cap company, just over $1.5 billion enterprise value company. So it's not a bet the whole firm type acquisition, but $270 million is a meaningful acquisition for them. So, Johnny, it sounds like you guys like this deal. Do you want to talk about why you like this deal? And kind of, we can also talk share repurchase, because I love a good share repurchase, and they've done some of that too. But just talk about their acquisition strategy, Johnny Was, and what you think going forward. I guess, Eric, I'll toss it over to you to start.
Yeah, sure. So we don't know a whole lot about this. It was announced essentially last month, but Johnny Was has 60 stores. They think they can grow that to about 160. There's a skew towards California. It's kind of a casual beachwear female line. They're smaller store unit level in terms of size. So I think they're generating about 2 to 2.4 million per store. And I think their belief is they can expand this nationally into the markets where it's relevant in kind of warmer weather climates. And use kind of their core skill set that they've used and utilizing with probably most likely Lilly Pulitzer. And I think there'll be more to come. They just kind of provided those initial numbers, and some of which we kind of were able to find out through back end, kind of looking at the business from kind of scoping it out online.
Brandon, did you want to add anything there?
No, I think you nailed it. I mean, it's a interesting double-digit revenue growing business. And however much they had $200 million of cash on the balance sheet, I don't really think investors were giving them credit for that, because they kind of knew it was going to be deployed for an acquisition. They haven't made an acquisition in quite a while. They've actually closed down a couple brands that were underperforming.
Yep.
Which is, if your management team's paid on EPS and they close down a couple brands, it kind of takes away from the earnings per share. So we were really impressed that they would do that. But now this accretive acquisition, and they haven't really told us too much about it. That's like the funny part, is they make this big acquisition, don't even hold a conference call. So
I was laughing. I was trying to find the conference call. They do a big acquisition. They put out I guess it's about a 9-page slide deck, but 6 of the pages are almost just like it's one model for Johnny Was with, acquisition overview or something on it. Like there's really just not a lot of information there. Let me talk quickly. Speaking of acquisitions, one that I keep jumping into my mind is I mentioned it at the start. Last year, CROX buys HeyDude, and HeyDude is not really a comp for Tommy Bahama in any way. We're talking completely different things. HeyDude is almost exclusively shoes. They don't have a lot of direct to consumer. I guess they do have a decent bit of digital, but they're mainly doing wholesale through things. But the one thing that jumps out to me is CROX pays $2.5 billion for HeyDude, about 15 times EV to EBITDA, approaching 4 times revenue. And I just, I look at that and I have to wonder, are you guys looking at, and we've talked almost exclusively Tommy Bahama here. I mean, Lilly Pulitzer is a real brand, but Tommy Bahama's the majority of sales, the pretty big majority of earnings. So that's really why we focused here. Do you guys look at that HeyDude transaction, or there've been other transactions in the brand space, and say, oh, like the market, for all the reasons we've discussed, this is named Oxford, this is Barry, people are worried, the market is really missing, the multiple for these brands it's pretty big.
Yeah, I don't think we'll use those as like comps. I mean, that'd be like a triple to the stock if they were to sell it that multiple, which is, we're never underwriting anything on a acquisition takeout premium, but Yeah, no, absolutely. There's a huge disconnect in the valuation. I mean, that is, I think, going to become more stark as they start to put up, sustainably higher margins and continue to grow at an accelerating rate or an attractive rate. But that's where we stand exactly.
Do you think we've joked about this company being named Oxford a few times? Again, this is a little bit of softball, but it does strike me. Monster Energy drink it still might be the best performing stock of this century. For a long time, it was like the best performing stock of the past 10, 20 years. And obviously that's a huge growth story and you need the fundamentals to work and all that. But one of the things people would always say is Monster Energy drink, I can't even remember what it was called anymore, but for a long time, it was called something different because it was this small brand that grew into this enormous thing under another thing. And for a long time, people would say, look, one of the issues with the company is the stock is like undervalued because people don't realize, it's named Oxford soft drinks or something, right? Not Monster Energy drink. So people don't give it the thing. It doesn't like get the immediate recognition. If they would change that, the stock would almost get a 6 months pop as people just got comfortable. Oh, I'm buying Monster Energy drinks, not some random industrial. Do you think, you mentioned Investor Day next year, do you think longer term there's almost a little bit of, hey, when they change their name to Tommy Bahama & Co. or something, there's going to be some type of pop, or that'll be like a catalyst for investor recognition?
I'll tell you one funny thing. Oh, go ahead, Eric.
No, I think that, not to interrupt, but I think that would. They haven't formally announced any of that intention, but certainly. And, getting back to the Johnny Was real quick, I mean, the granularity, the detail of the financials for this company is exceptional. So we'll start to really see that. Like they delineate Tommy Bahama, earnings, revenue, lots of metrics that others don't. And we'll probably start seeing that as soon as next quarter for Johnny Was. But Brandon, feel free to add.
No, that's exactly right. I think the funny thing, we always say everyone always thinks Oxford Industries is just like contract apparel manufacturer, and that's because it was, IPO'd I think in 1965, and that's what they did for the history of the company.
IPO'd in 1965. I think they even say in their deck, we've paid a dividend for like 40 or 50 years consecutively, and obviously with their cash flow they can keep doing that. But at 65, like they were paying a dividend as a contract manufacturer. They've been doing this for a long time.
And yeah, so I think that's everyone's perception of it. And it's somewhat of a double whammy too, is because once you realize that, they actually shut that business down, and they actually shut down the last of it this year, their own like Oxford brand and the contract apparel manufacturers. It's a little bit of a double whammy because people realize, okay, so this is actually a Tommy Bahama and group, but Tommy Bahama is a joke brand. And I think we like to reference the Family Guy spoof of it. I think everyone's like has that in the back of their head, that Family Guy spoof, and I think they see Tommy Bahama and they go, "Oh, that's a joke brand. I'm not, why would I want to invest in that?" So it's not even, you have to like educate the investor like even another further step beyond just having a somewhat confusing name.
No, it's funny you mentioned the joke, because the next thing I was going to ask you is they're opening, just to reiterate kind of the brand strength and what's developing here. They're opening a Tommy Bahama hotel and like kind of luxury resort in California. And I think it's slated to open in late 23. And it's funny you mentioned the joke, because the first thing that pops up, there's a Travel and Leisure article, and it's almost making a joke out of it. It says, that's right, there's going to be a Tommy Bahama hotel, right? So like clearly people are thinking, oh, this is more of a joke brand. They're not understanding the brand power here, underestimating it, or maybe they're waiting for it to be proven out. But I wanted to mention that California resort, A, to do another indication of kind of brand power, but B, to ask, like, how will you know if you're wrong, or if the Tommy Bahama brand like kind of doesn't have these legs, if there's shifts? Would it be, I mean, one early indication would be this hotel project failing or not filling up, but what are some other ways you guys kind of track that the Tommy Bahama brand is not a fad story, that it's staying on strength, that it's continuing to grow?
Well, I think with the California hotel, they're not like building the hotel. That most likely, it was only recently announced, will be like a royalty agreement as well. So it's not like there's a huge capital deployment there.
Royalty agreement, but if it's 20% occupancy for a year, it's like, oh, the Tommy Bahama hotel can't really attract people.
Yeah, right. So they're not, exactly. I don't think they're necessarily bearing that that is much risk there. But I'd say what do we look to? I mean, 30 years of continuously kind of cultivated, the brand affiliation's high, these retirees or older folks, and it's, you know, kind of people retiring younger that continue to do this. The pricing, they continue to raise pricing. We closely track that. You know, they're $120 polos, almost none of which have been discounted. You're seeing a lot of discounting starting from kind of the lower end and some of the peers where there's plenty of other options out there, even polo and the like. And you know the kind of ongoing kind of sustainability that is, I think, demonstrated in the historicals and kind of what we're seeing in the, you know, the current environment.
Did you want to add anything there, Eric?
So we, I think I mentioned, I think we talked to a former marketing guy, and I think the questions you're kind of picking up on is exactly what we picked them, and, you know, we were asking about. And I think he just had this one really interesting quote. It was obviously no one has a crystal ball, but he goes, you know, I was there, and he's like, we never saw a cliff in sales. He's like, they never really got too high, never really got too low. Kind of been like steady Eddie. You know, they spent 5% of revenue on advertising, and that just hasn't changed in the years. He's like, they're actually probably not pushing as hard as they should. But, you know, people will keep going on vacations. People will keep retiring. Their customer probably has a boat in Florida, probably spends at least half his year there. You know, I said my parents have a place down there. I mean, they live in Syracuse, which is, you know, obviously the snowiest city in continental United States. So they like to get away for the, but they do that every year, kind of like regardless of what's going on. So I think that's who they're selling to, and their customers didn't get stimulus checks. They didn't have this like big bump like, you know, we saw in Foot Locker and some other of the lower end guys. So they've kind of just been steady Eddie grow, and they are what we learned is a first look. So if I'm going on vacation or if I'm going to the beach, a lot of their customers will use Tommy Bahama as their first look, and a small portion of them are recurring ones that make up the lion's share of profits. This is something else that we learned. And I think that gives us confidence that this is more than just a 1 year, you know, like we said, COVID beneficiary.
And Eric, I just wanted to add something to, I thought you made a great point. Hey, no discounting. I'm just looking at their website off the corner of my eye, and it's, you know, everything on there. We're talking the Thursday after Black Friday, right? So lots of brands are still doing lots of discounting, trying to get those Christmas sales in. I don't really see I'm only looking at the men's polos and t-shirts. I don't see anything discounted. You know, the one offer I do see is if you spend $175, they'll give you a $50 gift card that you can use in January, right? So they're almost like pre-selling something. Obviously, there's a cost to that gift card, but they're saying spend $175 now, get 50, which I'm very familiar with these things, because what they're hoping is when you come to spend that 50, your basket adds it to 100, you throw another $50 in cash there. And either way, the gross margins on these things are very high. So they'll be profitable even if you only spend that $50 gift card, but they're hoping they get that. It encourages a repeat visit. They're encouraging repeat behavior. So I think that's really smart. And, you know, I'm saying that because it sounds $50 gift card on 175, they're discounting. And technically, yes, but that's, you know, Miles Apparel is one I like. They're doing, hey, everything's 40% off, spend 100 and get an extra 10% off, spend 200, get an extra. Like, they're nowhere close to that. They're doing a small discount to encourage repeat visit and a big basket. So that I think that kind of speaks to the brand strength. I love capital returns. I love capital allocation. I think I'll let you guys talk to the share buybacks. As you mentioned, Johnny Waugh's acquisition, they've got plenty of cash. They could continue share buybacks, might slow down a little in Q3 and Q4 just as they close and integrate. But let's just talk. They've done dividends for a long time. I'm rambling. I'll throw it over to you guys. Capital returns for the company.
Management focuses on GAAP EPS. So I think for us, we were, okay, these guys are aligned with us. And I think you brought up a great point is, you know, we would love for them to own some more stock. It's, you know, they have some stock, we love for them to own more, but because they are, you know, aligned with shareholders, we think they'll keep delivering for us. And historically, they, you know, they had debt on the balance sheet maybe 7 years ago, paid it all off, built up a huge surplus of cash, and it kind of weighs down your PE multiple. So people were kind of like, hey, what are they going to do with it? They bought back $100 million of stock, which was, I think, 5.5% of shares outstanding, which is just phenomenal. There's almost no stock-based compensation in this business either. So it's just pure to the bottom line. And going forward, now they have about $100 million on the credit revolver just from Johnny Waz. They'll pay that down by second half of next year, and then from there we're kind of hoping they'll keep building up that cash. We like this business to be very well capitalized. They're not opening up new locations that much, so there really is no upfront capital investment here. Like we see a lot of the smaller guys that are like Boot Barn is a great example. They did a conference call and said, we're going to triple our store base. This isn't that story. They have 110 locations and they'll probably have 120 in like 3 years.
and that's because it's a premium brand, right? Like there are only so many locations when you're selling $100 pullovers. That's great, but you're not going to sell $100 pullovers in, I'm from New Orleans. You're not going to do it 30 minutes outside New Orleans in some small town. Like it needs to be in a premium location. Again, these are floral brands, so you're probably going to want to do it in New York City. Makes lots of sense because everybody wants a flagship, but you're probably going to want to do it in a Naples, right? With a warm climate, beaches close by, all that type of stuff. Eric, did you want to add anything there?
No, I think that's right. You got the growth has come from pricing, higher turns per store, and then this improved channel, as opposed to a huge growth by new store opening profile.
Well, guys, I think we've covered all of my notes, most of my questions and everything. I do just want to, again, I think we've done a great job covering it. We talked about valuation. We talked about what kind of the shorts and the street might be missing, what people might be missing when they think this is industrial. But I just want to turn it over to y'all. Is there anything you think we kind of glanced over that we should have hit harder, or anything we didn't talk about that you think people should be thinking about as they look at this name?
So we've talked a lot about kind of like the perception of peak or sales, but I think one of just as important, perhaps more so, is the peak kind of earnings and margin. I think Brandon had mentioned earlier, this mix shift that's occurred is, that's a permanent structural change. In fact, there's actually some tailwinds to this being moderation in cotton prices, freight costs moderation. They were shipping a lot by air last year to meet inventory in short notice. Now that's going to go by freight. Freight rates have also declined. And some of those other kind of, we're looking at a margin profile I think that is sustainable, if not will increase. So versus what I think is perceived, at least on the bear side, is a reversion back to 2019 levels. And next couple of quarters, I think they'll be disproved, if not, in the next quarter.
Brandon, anything else from you?
Yeah, no, I think, it's very comprehensive. Appreciate the detail there. One really interesting too, I think maybe we'll just touch on it if it closes. This inventory is on everyone's mind. Like, oh my God, these guys got a bunch of inventory they have to discount. And I think what we found really encouraging was that inventory is actually 2 or 3% below where it was in Q2 19. Revenue's up 25%, just about. And what they did, and we've started to appreciate more, is they created a ship from store inventory management system just in 2020. And they've also reduced their SKU count massively over the years. They used to have 15 polos, or it was an insane amount of polos. Now they don't have as many. Maybe only 2 or 3 different price tiers: good, better, best. And that just drastically reduced their inventory. So we think going into the key holiday season, they're very well positioned. And we're excited to see what they do.
Just on inventory with Tommy Bahama, like there's always fashion risk, and inventory and retail is always a concern. And I kind of agree with you, and we can talk about what they said in the call and everything. But does Tommy Bahama, I would guess it doesn't have as much kind of fashion or stale risk as is something more fashionable, like my floral polo or whatever is going to be, it's going to be in demand in 2022. It's going to be in demand in 2023. Like, I would guess there's just a little less obsolescence risk. Would you agree with that? Or am I kind of off? Because it is high price. Maybe you do need to keep it a little bit fresher.
You're right. And that's kind of our fault for not referencing this up sooner. But, Eric and I aren't fashion guys, not even really, retail guys. It's not where we play. But what we did like is, if you go back to, 10 years and you look at Tommy Bahama Polo, it's just, you're really selling to, dads over 65, and like their fashion trends aren't really changing that fast. So that's what really, I think, gave us confidence in this business. And as you mentioned, Crocs, Crocs can be really cool one year. It's actually big with dads, and then not so cool the next year. And they did really take a initiative, or less, coming into COVID, to switch what they called it 1/3 basic, 2/3 fashion. They flipped it to 2/3 basic, 1/3 fashion. And that's where we saw with the reduced SKU count, and that's where they're positioned today. And that gives you a huge benefit in the Q next year, where you're past season, you're not having to dump last year's fashion inventory that didn't sell. So they really cleaned up the business nicely.
Yeah. And just on inventory, I'll lob you guys another softball, because I know it's been a bear case. They've said, oh, they're over inventoried. I just, when I was reading the Q2 call, they sounded very confident on it. And then a couple of weeks later, they came out and actually raised their guidance for the year. Like, I kind of thought that would put the inventory issue to rest short term, at least. Now, I've certainly seen companies say, this, even as recently as this year in April, they said, don't worry, inventory's fine, sales trends are picking up. And then they come back and report in July, they say, June was a disaster. We're over inventoried. Everything must go. We're marking down. So it's not that they're completely off the hook. They could have been wrong. Trends could have turned. They could be like, there's all sorts of things. But I did kind of think that got put to bed, at least temporarily, by that. Eric, did you want to add anything there?
I think that's right. And frankly, the fact that they're not discounting would suggest that, you can go get a polo for 50% off, like you referenced, from Ralph Lauren. You can't at Tommy Bahama. Their quality and pricing power is going to demonstrate through this period where a lot of peers are being forced to cut prices.
Perfect. Well, hey guys, I think I'll wrap it up there. I should have mentioned right at the top of the show, they've put together a PDF presentation that walks through all of their thesis, all of their bullet points, valuation, everything. I'll include a link in the show notes. I'll tweet it out. So I'm sure people will be able to find that there, but people should be sure to check that out. Brandon, Eric, thank you guys so much for coming on. Looking forward to having you guys again. And more than that, looking forward, I'll send you some reviews from the Marlin Bar. I think Tommy Bahama's up my dad's angle, so maybe I'll get him something for Christmas. I'm going to be sending you guys some reviews, doing some due diligence on this thing.
Look forward to it. Great. Thank you, Andrew. Really appreciate the time. Yeah. Exactly.
Thanks again, guys. Talk to y'all soon. All right. I'm here with Thomas Lee, the founder of DeLupa. Thomas, I guess you wanted to start off by just asking, why don't you tell people, they hear the 30-second brief at the beginning of every podcast, but what is DeLupa and kind of why did you start the company up?
Yeah, hey, thanks, Andrew. So DeLupa is a company that, my co-founders and I started about 3.5 years ago. The idea was really born out of the pain point where, as a former TMT buy-side analyst, it was very annoying to build and update models, right? You spend a lot of your time building models and updating these models, but really you want to be spending most of your time thinking about your assumptions, thinking about the macroeconomic situation as it pertains to your company, and not the data entry, data scrubbing piece of it. So DeLupa was really created just to automate away as many of those problems as possible. Very simply, DeLupa aims to serve two purposes. The first purpose is, in a click of a button, your existing models should update, right? No ifs, no buts, everything just works. And it almost feels like magic to a lot of our users, because what you're used to during earnings season is you sit there, you open up the AK and the 10Qs, and you start punching in numbers. You're trying to juggle, 4 different earnings calls. Everyone is asking you what is going on. You are trying to figure out what is going on. And you have this very mundane task to do of updating your models. If you don't get it done in time, the next day it just starts snowballing and snowballing. And earnings season just becomes a really painful period of time for most analysts, right? Back then, it was by far the most time-consuming period of my quarter. And what DeLupa does is it simplifies all of those problems away into a simple click, right? You click a button, your model updates, and you're off to the races to do the stuff that you actually enjoy as an analyst. The second value of DeLupa is we have scrubbed thousands of companies. At this point, we're well over 3,000 companies of financials. And we've read every 10Q, every AK, every investor deck. We pulled out every KPI, every adjustment, guidance, financials, like every tiny detail that you're expected to scrub to build a model, we have done. Right? We've built a bunch of tools around it such that you can audit into every single number. So not only are our data hyper accurate, every single data point is auditable, and you can have access to everything. So what people do like about that is, if you're renting to a new name or a new space, you can just download a spreadsheet of everything that the company has ever disclosed. And it's a very good starting point to build a new model, because it doesn't come with assumptions that you don't agree with. It doesn't come with 15 different tabs that's difficult to work through. It's just a clean set of historical data for you to use. So in short, that's what we do. right? We give you perfect data, we update your models for you.
And you didn't even mention, when you were mentioning the earnings season thing, you didn't even mention the absolute analyst nightmare where a company goes and they change their segment reporting, right? And then your whole model's blown up because you need to go back and it's like, oh no, like everything's done. You've got everything custom built. So just for people, if someone goes and downloads one of your models, I'm sure people are familiar with, you go onto some like fly by night financial sites and it's just, they've got a computer kind of pulling things and people are really familiar with, all the data can be messy. It's pulling from the wrong thing. Like, are you having obviously computer scraping a lot of it, but are you having an actual analyst go in and kind of guarantee every model that they're looking at?
Yeah, we do. So in short, we have close to 200 AI algorithms that is checking every single data point. But on top of that, we also have a team of about 200 financial analysts, right? We check every single data point twice to make sure that they're correct. But more importantly, like Andrew, you pointed out, one of the big problems is restatements, resegmentation, or companies just disclosing new data. We're able to identify all the new data for you, such that in a single email, we'll tell you, hey, company X just reported earnings. Here's everything new that they have disclosed. Here's the file with all of the data. Everything new that's been disclosed is now highlighted in bright yellow, right? So that you no longer have this question of like, did the company disclose something new and I just happened to miss it? Because it's very easy to miss, especially if the data is like buried in a footnote. It's super easy to miss that. But for our customers, that no longer is a problem.
And as you said, the analysts can spend less time kind of digging through the things and just putting numbers into a model, and more times thinking about, hey, this new disclosure, is it actually useful? How does it change my impact on the business? Things like that. Exactly. Who's your typical customer who's actually using DeLamarter?
Yeah, our customers generally fall into 4 buckets. The first bucket, and probably our biggest bucket, are hedge funds. Most of these hedge funds tend to be long-short equity or long-short credit. The second bucket are long-onlys and mutual funds. Very similar use case to hedge funds, right? You maintain models, you got to keep them updated. The third bucket is investment banks, primarily in the equity research division, right? Just like their buy-side counterparts, the sell side has to maintain models. The difference is obviously sell side publishes the models, they publish research and so on. And what a lot of our big investment bank customers have told us is the reality is nobody actually wants to be updating the model, but it's something important in their process so that they can start thinking about the research notes to write, management calls to get on, and so on. So that's the third bucket. And the fourth bucket is private equity. Private equity don't really maintain models the way like a long-short equity analyst would, but they spend a lot of time thinking about industries. They spend a lot of time thinking about, how does this company comp to something in my portfolio and so on. So what we see them do is, instead of building individual company models, they have a tendency to build KPI models for industry comps, right? Like we have customers building an industry model for every single software company's ARR in one Excel sheet. And there's like over 250 software companies out there. So if you have that Excel sheet, you can maintain and update it again at a click of a button, versus what they historically had to do, which is open 250 AKs and manually go through them.
I'm very familiar with that task. Anything else people who are thinking about DeLamarter, kind of listeners of the podcast who are thinking about DeLamarter, should know, or where can they reach out to find out more about you guys?
Yeah, so you can reach out to us just by going to our website, DALOOPA.com. There's contact details up there. One of the, as a listener of the podcast myself, like one of the things I know a lot of listeners care about is like just the granularity of things that's being disclosed. It's almost as important, the level of detail in the way companies do disclose or choose not to disclose certain numbers is almost as important as the financials, if you will. So what a lot of customers have told us that's interesting is, after they've downloaded their sheets, they realize that there is so much data that the company has actually disclosed that they weren't even aware of, right? There might be a period of time where the company was burying in footnotes, tiny details, and then they stopped that process for a year and they restarted the process. Like that level of detail is something that you don't get anywhere else.
It's a little off script, but it's so dumb, and it's something I've thought about writing about before. Like a lot of times I'll follow a company for a year or two, and there'll be a disclosure that they make that I won't really pay any attention to. And I can't tell you the number of times, like 9 months later, when I'm smarter on the company or something weird happens to the company, I'm like, oh, that's why they're making that disclosure. Like the disclosures that companies make, they generally don't they generally don't put them out there for no reason, right? Like it actually takes time and effort for them to get into SEC statements, for lawyers to approve them, all that type of stuff. So they're generally there for a reason. And one of the nice things with the tracking and stuff is if it's there, you can track it and you can quickly go to it, see how it's changing. And as you said, see anything new, because especially when new stuff comes, it's like, hey, a lawyer probably told somebody it's really important for you to disclose this, or the CFO when it said, hey, if we disclose this to our investors, they're going to be really excited about it and it might move the stock or something. So like there really is a reason. So that's completely off script, but it really struck something I've thought about a lot. Any last thoughts before we wrap this up?
Yeah, and to that point, yeah, the last thought is sometimes it's also relevant when a company doesn't disclose something.
Yes.
Right. So where it gets very interesting, a lot of people have pointed out to us, is because we do such a good job at stringing together the time series of data, especially in stuff like it's in the chart or it's in a footnote, and you just don't realize when the company has dropped that disclosure. But when you open up the DeLamarter file, you see every single disclosure and therefore every time series. So when you notice that something has stopped being disclosed, sometimes that's a key signal for you to pay attention to what's going on.
Oh, 100%. And obviously short sellers especially are all over this. Hey, this company used to disclose unit economics, or they used to disclose churn, and now they've stopped disclosing it. So anyway, I think we should probably wrap it up here. But Thomas, this has been great. Anybody can go check out DeLamarter. That's DALOOPA.com to kind of check the company out. And Thomas, thanks again for coming on.
Thank you, Andrew.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.